Good morning. I'm Ken Leon, Director of Equity Research, and welcome to CFRA's webinar series, The Road to Recovery. Today, we're really excited to be speaking about disruptive technologies and cloud computing opportunities accelerate. Presenting today are John Friedman, Vice President Industry Analyst, CFRA, and he'll be focusing mostly on cloud, software, Moore's Law, and Angelo Zeno, Vice President Industry Analyst, who will give the perspective on these topics on the semiconductors. Next. Many have seen this slide before, but we're really proud of our history and where we are positioned in the market for CFRA. CFRA has a leader in terms of research innovation, and we are growing. We've become more dynamic, not only offering fundamental equity research as we do today, but also our best-in-class forensic accounting and ETF and mutual funds. Back in 2019, we acquired FirstBridge, which has given us comprehensive data to do things to put us really in a world-class position for ETFs. And today, with over 75 investment professionals, we're one of the largest independent research firms. Next. So the engine for our research is our analysts, and our analysts are stacked, as you can see here, working together, collaborating, certainly from a macro top-down perspective with our market commentary, sector insights, led by Sam Stovall, our Chief Investment Strategist. The collaboration is with our sector heads on sector and industry research, and also in terms of enabling our customers to invest in different ways, not just in single securities, but ETFs and funds. Heading up that team is Todd Rosenbluth. Company research is the foundation of our fundamental research practice. Our analysts cover 1,500 global companies, and these are done with in-depth analysis and publishing on our platform MarketScope Advisor. Additionally, we do thematic research and industry surveys. We additionally have, if 1,500 companies is not enough, a quantitative database of 25,000 companies that we do not cover. Another aspect of collaboration with our forensic team is the diagnostic work that we're able to see really in a unique position in the market for risk mitigation, or in the case of portfolios, portfolio risk monitoring. And what I'm most proud about from the team, and they're on MarketScope Advisor every week, especially on Monday, but through the week, is our thematic research. And the flywheel from that comes from idea generation, speaking about trends, as you'll hear from John and Angelo today. That filters into our viewpoints for portfolios with sectors and industries. And we're just really excited where we are, and we're going to have a lot of exciting things that we'll be doing over the next 12 months. Next slide, please. So obviously, all the great things that I've spoken to right now wouldn't be good unless we could demonstrate that you could act and rely on CFRA in terms of performance. And this is a snapshot that goes back to May of this year. On a one-year trailing basis, we were ranked #1 on a combined buy and sell. So many of the Wall Street firms are shy of sell recommendations. You know, we as an independent research firm are more objective, but certainly we do very well with our strong buys and buys. So we're very proud for those research firms covering over 900 stocks that we are, you know, one of the leaders. Next. So again, this is a regular slide in our webinars, but it's really to the core of who CFRA is our independence. And I can tell you what I'm most proud about is that all of our resources are invested in our people and in our platform for one thing, and that's just to provide you research, whether it's fundamental or forensic research. We do not have any conflicts of interest that may arise from asset management, or we're not a broker-dealer as it relates even to investment banking. So we believe CFRA is a name in the marketplace that you can rely on. And while some of our competitors say they have unbiased ratings, it may not be the case. So with that, let me turn it over to John so we can kickstart this webinar. Good morning, John.
Good morning. Good morning. John Freeman here, CFRA. I cover enterprise software, internet and digital advertising, social media, as well as video game publishers. And today we're going to be talking about the enterprise software and cloud computing market. So there's four big trends that I think you have to kind of understand in enterprise software and cloud computing. These four trends are hopefully they'll be somewhat familiar to you, but these are really sort of long-term, powerful secular trends that are driving the industry. Cloud migration has been going on for about 20 years, but we are still in the middle of it, and probably won't cloud revenue. We don't expect to exceed traditional software revenue until, according to our forecast, 2023. So the point is that there's a lot of room to run. Digital transformation, everybody's been talking about it. It's all the business school curriculum. There's lots of definitions. We just simply see it as replacing, taking software and replacing physical capital and labor in the means of production, versus the sort of historical role of software, which is to just help managers manage the means of production. The derivative trend, meta software, we're going to talk about the rise of meta software. Basically, this is software that allows you to manage, develop, create, debug, monitor other software. And so the basic idea is that digital transformation is all about companies becoming more software oriented and substituting software in the means of production. You're going to need a lot more software to manage that. And then of course there's artificial intelligence, which I kind of see as an extension of digital transformation in some aspects, as well as sort of the next generation, if you will, of predictive analytics is kind of the other the other side of it. And the last thing I wanted to sort of remind everybody is that these four trends are obviously top of mind now. But one thing to keep in mind is that Moore's law, which is the predictive observation that Gordon Moore, for the co-founder of Intel, made in the 1960s about essentially the power and the storage ability of semiconductors essentially doubling every 2 years. And although that's there's a lot of controversy about if that's ending, but it really that's the engine that drives the software industry and allows you to do all of these amazing things. So let's go ahead and hit the next slide, please. Thank you. And let's talk about cloud migration. So as I said, this was pioneered by Salesforce.com, and NetSuite is another a big early pioneer. And the basic idea is, instead of running software on your own corporate premises, if you're an enterprise, right, and in your own data centers, what you do is you just subscribe to the service that is run by the cloud provider, for example, Salesforce.com, and your web browser is your window, is your remote access vehicle to that software, and then you pay by subscription rather than paying for licenses and upgrades and maintenance. We see cloud kind of crossing that first chasm, as they talk about in terms of technology adoption during the 2008-2009 financial crisis. It was really the first time large enterprises started to migrate their applications from their own premises to the cloud, and they did so because of the cost pressures, a lot of it because of the cost pressures of the financial crisis and following recession. So, we think that this has also happened before, where financial crises have accelerated particular trends. The original, client server trend back in the early 90s was partially precipitated by the recession at that time. So, we're having an economic downturn now, so we also see that cloud migration is going to be accelerated because of the financial and economic pressures due to COVID-19. Yet, as you mentioned, and you can see, you'll see this in subsequent slides. Cloud migration has a lot of room to run. There's a lot more applications that will be moving from enterprise premises to data centers that are operated by the cloud service providers. And now I think even mission critical apps are moving. And when mission critical apps move to the cloud, right, there's sort of there's a real premium on those apps, which I think does contribute to growth of cloud versus traditional to some degree. And so I think this is as the ROI, the return on investment of cloud, kind of becomes more clear with an economic downturn. I think that just pushes a lot of these enterprises that are they have having their sort of organizational inertia, or maybe they're they have issues with security or reliability, these things like that. It allows them to get over that and continue this cloud migration trend. Next slide, please. So here, this slide just kind of shows you the different types of cloud computing architectures. Over on the left is the traditional on-premise software, and that is what you see there is a software stack. The different sort of layers of software, and then even at the bottom hardware that run a system, right? So when you have then all the way on the right-hand side, this is there you have infrastructure as a service, where, and this is Amazon's AWS is a great example. Microsoft Azure is another example, where the essentially they're just presenting a server, right? They're presenting an operating system and server so that it looks like it's on a traditional on-premise from the application developer's point of view. And then, as you see, platform as a service has takes the database and app server and all that other stuff away from it, and allows the enterprise to focus just on configuring the application itself. And then we have software as a service, right, where you get the whole stack, and really it's just there's really no programming or development from the enterprise's perspective. It's simply the configuration of the application. Salesforce.com is a great example of that. And platform as a service, I think a good example is Amazon's AWS has moved into this. Microsoft's another example, as well as Salesforce's Force.com platform is another good example. Next slide, please. So this is just our this is the historical numbers from IDC, and then our forecast on top of that of the different types of cloud computing and different types of enterprise software. So you can see there's infrastructure software and the corresponding cloud version of IaaS, infrastructure as a service, and then on-premise platform software that's like databases and middleware and things like that. And then PaaS, which is a little bit easier acronym to pronounce, right there, and really sort of taking off, from 2001, 2021, 2022, as these guys move these mission critical applications. A lot of them won't want to convert it to pure software as a service. They want to leave it as it is so it doesn't break. So that's why that I think that will drive additional growth for Microsoft Azure, for AWS, and for Google Cloud on the PaaS and infrastructure as a service side. Next slide, please. And then the next two slides are a breakdown of what we just saw just by sort of application. So this is just straight, SaaS software as a service, right, versus the traditional application revenue. And as you can see on this here, SaaS has got a fair amount of progress on traditional on-prem application software in terms of revenue. As you can see, that crosses over the 50% mark, according to our forecast, as early as next year, 2021. Next slide, please. And here we have the infrastructure side, and as you see, it's not quite as large, and it's not quite as penetrated versus traditional software. And the reason for that is because no matter what you do, you kind of always have to have some degree of infrastructure software, even if it's in a cloud provider's data center. That's why, in order to cut their costs, guys like Amazon and Microsoft and Google, they actually develop, or Amazon, completely develop their own stack so that they didn't have to pay anybody royalties on their database and operating system software that they have to use, right? So let's see. Oh, the other I think that the important part about this is that software as a service, or the cloud version of infrastructure software, is really deflationary for infrastructure and platform software, which, by the way, is not great news for Oracle. But as you can see here, it really doesn't cross the 50% mark until 2024. You blend them together, to take the total cloud, that crosses in 2023 in terms of the total market, crossing being 50 or more than 50% of the the total cloud market being total more than 50% of the total enterprise software market. Next slide, please. The next trend we're going to talk about is digital transformation. Everybody talks about this, but it does seem kind of vague. And I talk to people, and nobody really likes the name just because it is so vague. But what else? That's the term that we're kind of stuck with, I guess. So we'll just, I just go ahead and use it, even though I don't particularly like it. And the way we define digital transformation is the direct substitution of software for labor and physical, mechanical capital in the means of production. And that is in contrast to software's, main historical role, which is the management of the means of production, ERP software, CRM software, all this software from the client server era, or even before in the mainframe and mini era. That software was used to manage the means of production. And now what we're talking about is actually substituting directly. And I think sometimes that's a little tough to get your head around. So I think but I think the examples are key, right? So Uber is a great example of this. They basically developed software that replaced the taxi dispatch function, right? And all the people that were, right? And then they scaled it nationally. So that's, I think that's a good example. Some, less high-profile examples, but certainly just as important. Schlumberger is the oil field services giant, and they have developed a lot of their own, multiple applications on their own that used to be handled by people, by analysts, right? And essentially what they did, instead of actually replacing those people, what happened is when they wrote that software, it allowed the people who analyze the seismic data to just be able to analyze a lot more data and be a lot more accurate in doing so. We think COVID-19 and because of the work from home requirements and things like that, I think it definitely is a catalyst for digital transformation. But I think digital transformation is kind of so large and broad a trend that while it's accelerated, I'm not sure that COVID-19 specifically with digital transformation is quite as investment relevant. However, next slide, please. So the rise of meta software, I think, is in a way kind of the investment relevant way to invest in digital transformation and to look at digital transformation. It's a driven, right? So the idea is pretty simple. If all of these companies are becoming, more like software companies, right, and substitute software increasingly in the means of production, it's going to become more critical. You can't kind of go back into manual mode, right? So if that's the case, you really need good software to handle your software. Traditionally, software that I kind of call meta software, right? It has kind of been niche-y. It's been around for a long time. Obviously, you have to have software to monitor other software or help develop it and debug it and all of that stuff. But that was kind of the role of IT. But now what you're seeing, is really meta software kind of breaking out and becoming strategically critical to a lot of companies. The whole sort of concept here, and the light bulb went off in my head. I would say about 7-8 years ago. I was doing a due diligence project for the venture capital firm was looking at Uber. And what did all the Uber guys had Atlassian and New Relic and all of these applications up and running, and we're looking at them and then talking to us. So it was clear that the executives at Uber were really relying, on these tools. So that kind of got me thinking about how this is a distinct and really important trend. I think Microsoft is with Azure and the tools and the development tools that come with it. Microsoft is definitely a winner here, and we have a strong buy. Salesforce.com as well, but also New Relic, even though they did get hit last week. I think the secular trend, despite their operational execution, issues, I think the secular trend and their technology is so good that we maintain our strong buy on New Relic as well. And then, as you can see, Atlassian ServiceNow, Atlassian ServiceNow also buys relative to this trend. Next slide, please. So artificial intelligence, it's like its natural equivalent. AI is not one thing, right? It's many things. So, and I'm not even sure that intelligence is the right word, because it kind of makes us think about software being like us, and that's not really, that's obviously that may happen down the road, but right now we're just talking about very specific, narrowly defined contexts where AI is applied such that it can handle cognition like it's, basically you're just adding cognition to software so that it can adapt to various, input, output, changing conditions in order to fulfill some higher goal, some higher role, like, being able to tell if a particular video has cats in it, as an example, right? And over time, that software, those algorithms actually get better and better and better. That's the idea, is you train it. And so that, at this point, there is software, this is true, that can identify cat videos a lot better than humans can, right? And obviously there's going to be many things that, are not going to be able to do that for a time, but there's a lot of things you can, that you can do that with, and that can add just tremendous value. I think that's pretty. I think the opportunity for artificial intelligence, I think it's pretty obvious. I think it seems obvious to me. But there's also a lot of potential for fakery, for deep disappointment, and so we expect really wide swings in, AI's hype cycle, to borrow a term from industry analysis from the Gartner, right? So what we look at is companies that can use AI to solve very well-defined specific problems. I think Google has that in spades, as well as a platform to allow other companies, right, to use their architecture, the TensorFlow architecture, to develop AI applications in specific use cases. Microsoft again, Salesforce again, ServiceNow also using machine learning to really boost their software, which allows you to digitize and optimize workflows, right? And Nice Systems uses AI really, impressively to understand, for its call center software, to understand, when the customer is upset, right? And when what kind of particular responses might be helpful in various kinds of situations. They also use it to discover fraud, right? So that's all these companies we have this year, FICO as well, Fair Isaac also uses it to figure out whether people can pay back loans. I think these are the kinds of things that that are really the big opportunity for AI over the next few years, and not a more it's like a artificially intelligent digital assistant. I think that's a couple of years away, before we get to that more sort of generalized cognitive ability in software. Next slide, please. So here we have, this is just IDC's assessment of the AI market, assessment and forecast. As you can see, I mean, I think the standalone app, AI is probably a more accurate assessment of the market and forecast. Whereas embedded AI, I don't know if it's $100 billion market right now. That's kind of tough to say how much value there is in it. But then again, if you look at Google, Google's also uses AI for its own purposes and search. So what's that value to Google? Pretty tremendous. So it's kind of hard to put a number on it, but I think this kind of gives it kind of tells you what sort of size field you're standing in. So next slide, please. So real quick, we want to cover sort of how the way we look at software and all of these trends. We look at software as and picking winners in software relative to Moore's law. Now, Moore's law is the observation that Gordon Moore made in the 1960s. And technically said that the transistor density, constant transistor density of a chip would double first it said 18 months, extended it to 2 years. It's been pretty much true since 2015. A lot of times people extend it, and it's roughly, I think you can make the substitution roughly that Moore's law essentially gives you an idea of how fast, it's a doubling of computer power, networking power, and storage power now that they're used, for solid state storage. So I think that's the way to think about it. And every 2 years, it's like the software industry gets this huge surplus of transistors that they can do stuff with. And they are either able to, create and disrupt with something entirely new that really is attractive and has value, or they can use it to upgrade and sustain existing applications. And then if they can't do that, then they're on the wrong side of Moore's law, right? And if they can't do that, then what happens is their software gets commoditized. It becomes easy, to write, because of all you get the surplus of transistors. Writing back in the calculator applications, it's not that hard anymore once you have a lot of transistor surplus. So that's kind of how we view the world and how we assess software companies. Next slide, please. And here's just this is the classic graph that everyone shows, of and it's logarithmic. Obviously, you notice that, and it shows that exponential improvement in computing power, i.e., transistor cost constant transistor density, all the way back to 1970. In fact, you can go even further back when it was a single transistor in the 1950s. But this is what is, this is what drives tech. This is what drives this is the underlying engine that has made all of this stuff possible. And I just think that's always a good thing to keep in mind. Next slide, please. And here, that value, I think I like this slide because it kind of shows, the semiconductor industry, has grown tremendously, but what it's really doing is creating leverage so that, every increment of improvement on the semiconductor side translates to, really, increasing larger and larger amounts of value on the software side. And that software industry, those bubbles, by the way, that's not just the standard enterprise software industry. That's all software, so like custom development and related services. So I think that's the idea is that Moore's law basically drives. It's not just a semiconductor thing. It really lifts and even has a much bigger impact, a much larger impact in the software industry that rides on top of it. Next slide, please. And that is it. I leave it to Angelo Zeno to talk about semiconductors. Thank you very much.
Great, thanks a lot, John. All right, so, and hello everybody on the call today. So, I'll spend my time just looking at opportunities within the supply chain as it pertains to the data center space. Specifically, I'll discuss the chip makers where I really see the greatest opportunities, along with the memory and the storage providers. So, we believe the most powerful long-term secular opportunity for the industry really resides in the data center. So, this trend, of course, is going to be propelled by really the combination of two factors. First is being data center, and the second, kind of the rising need for AI capabilities across a host of end markets, which kind of John alluded to. And, despite the fact that we're seeing a slowing IT spending environment here in 2020 amid this pandemic, data growth is actually accelerating, and that's kind of, again, being driven by the online usage from work from home employees. We all know that working from home leading to kind of the rising demand for data that's being created on the communication side, as well as increased downloaded stream videos from consumers. And then, of course, on the AI side of things, we've got this massive cloud war going on between some of the bigger players out there. And we think that's really going to support AI adoption out there. So going on to the next slide here. When we kind of look at data creation, we're looking for data growth at north of a 25% pace. Most of the data, or at least when you kind of look at data growth here over the next 3 years, we think it's going to exceed all the data that's been created over the last 3 years, which is absolutely impressive here. When we kind of look where that growth is coming from, it's really coming from the entertainment category. It's the biggest generator today, 45% of the 2020 market, and it's also growing at about a 30% annual pace. And then there's this other second category kind of called productivity embedded. That's really kind of where the enterprise participates, your kind of downloads, your video chats, and what have you. Also growing at an incredible pace, and that's really where the share gain is going to come from. Those last three categories, the non-entertainment, image, and voice, I mean, that's kind of like the photos you're taking with the cameras and all that stuff. That's about a third of the market. It's going to be a good growth area, but not as impressive as the other two areas out there. All right, next slide here. So if you're looking for where the growth is going to come from in terms of data growth, really going to come, where you would expect from a geographic perspective, and that's China and North America. And that kind of says it all. Just looking at the chart here. That being said, we do think participation in other regions, at least some of these emerging markets, kind of will take share in the years to come. Next slide. So when we kind of look at where the actual data is being stored now, it'll continue to be stored in the cloud, kind of amid a rising tide of data generation. But not only will the participants in the data center space benefit from greater data generation, but we expect the creation and storage of this data to really increasingly come from the public cloud. So you look at the moment, about 20% of annual data generated comes from the cloud. We see this figure gravitating towards 25% by 2024. Again, investments from the enterprise space, productivity enhancements, AI, really being the major contributors towards this trend. You also think about data generation at the edge. Autonomous cars also going to be a major kind of growth area for data growth out there. All right, so the next slide here. What we love most about chip makers and the storage providers tied to the data center end market is that they're really tied to the strongest and the best capitalized customers on the planet. So names like Microsoft and Amazon that can really spend in up or down economic times, right? And within the current market, we're seeing kind of the work from home theme really pulling in orders from cloud providers. Now, while the pandemic has definitely permanently changed the landscape for data center providers, I think it's also important to note that the magnitude of orders we're seeing today probably unsustainable, and we'll need to see a more normalized level as we exit the calendar year. So, it remains to really be seen exactly what a more normalized level will look like. But we're already seeing, enterprise governments as well as communication service providers beginning to take their foot off the gas here a little bit. We're also seeing, we've also seen inventories really start to build across the supply chain in recent months, and that kind of reflects concerns about a potential second wave, and these customers trying to avoid any potential supply disruptions like they saw earlier this year. Something to note with data centers, data center cycles typically last, we believe, about 4 to 6 quarters, and then they take a breather. And we do expect comparisons to get very difficult in the first half of 2021. I think investors, that being said, should refrain from calling cycles, but rather be rest assured that every future cycle has higher peaks. So every time I've really personally tried to call pullback in a company like AMD or NVIDIA, for instance, I've usually done a bad job timing the market. It's almost impossible to do. So if we kind of go to the next slide here, this is just a chart of the companies most tied to the data center, or the companies or the biggest customers within the cloud. And what I call them, and I typically call them the Super 8, right? Amazon, Microsoft, Facebook, Alphabet, Amazon, Alibaba, Baidu, and Tencent, all names you'd expect to hear. As you can see, 5 US-based, 3 Chinese companies. We expect to represent about 45 to 50% of the total CapEx dollars for the market. And all in all, we expect these companies year in and year out to progressively increase their capital spending plan. So a very, very good opportunity for the suppliers out there, because these companies will continue to spend. So as we go to the next slide here, just kind of looking at, what I'm going to do is really kind of talk about 4 major types of chips in the data center. The first one here is CPUs, which is a central processing unit. They're essentially the chips viewed to essentially be the brains of the server. Intel has historically dominated this market with above 95% market share. However, they're clearly losing share in major ground to AMD due to some of the manufacturing hiccups they've had. One was on 10 nanometers a couple of years ago, and they're now ramping up 10 nanometers. They recently announced that they're going to delay their next gen chips, that being 7 nanometers, by as much as 6 to 12 months. So clearly, it's a negative setup. Positive for a company called Taiwan Semiconductor, which is essentially the manufacturing partner for all the other chip makers out there, most notably Advanced Micro Devices, which is the main competitor to Intel on the CPU side of things. So, when we kind of look at Intel over the next couple of years, they're going to have a tough time here. They're going to lose some significant market share. In fact, we're looking for AMD to gain share from about 2% in 2018. They now have 10% of market share. We think that goes to about 30-35% over the next 3 years. And not only that, Intel's going to have to, not only with the market share loss, but we think margin compression, as well as challenges on the PC side of things, is going to make things pretty difficult for Intel over the next couple of years. So if we go to the next slide here, so this is just a slide on AI spending. And how we view it, kind of still in the very early innings. You can kind of see on the table on the left-hand side, kind of the trajectory here of AI server spending. Makes up about 10% of the market right now in terms of total servers. We think it's going to grow at north of a 25% clip on an annual basis. And if you look at what constitutes an AI server, it's really something called accelerators. And I'll discuss that in the next slide. But as far as kind of where the AI investments is being spent, you can see about half of it is on the cloud side of things in that pie chart. And at the end of the day, AI servers are growing about 5 times faster than your traditional CPUs out there. So as we kind of go to the next slide here, where I kind of alluded to accelerators, right? This is probably the most important slide in my view. I said I was going to highlight 4 important types of chips. So the first one being CPUs, dominated by Intel and AMD. The other 3 chips, GPUs, FPGAs, and ASICs. And all 3 chips are viewed as accelerators and have different benefits. So Often these chips are placed alongside the CPU inside a data center. So accelerated computing really gaining traction. And what, to define accelerated computing, it's essentially the ability to accelerate applications and workloads by offloading a portion of that, processing of a CPU onto some adjacent subsystems. So like a GPU or an FPGA. So think about being able to supercharge your PC in a data-intensive world. And these accelerators really are letting companies process tons of data in seconds, where in the past it would take weeks to do so for a CPU. So you can kind of see from that top right table, the actual accelerator, the benefits there. GPUs, and I don't want to kind of get into into each of these deeply, but really what you need to know, GPUs known for gaming platforms dominated by NVIDIA and AMD. NVIDIA has about 95% of the market. They're the best chipsets out there in terms of machine learning and now what's called inferencing capabilities. If there's one chipset, we do have an issue at the moment. It would actually be what's called FPGAs, the field programmable gate arrays. That's dominated by a company called Xilinx, and then Intel from their acquisition of Altera a couple of years ago. The problem here is that these chipsets are very expensive, and now what's happening is a lot of these cloud companies like Microsoft and Alphabet are starting to actually invest heavily on designing their own chips, utilizing companies like Broadcom and Marvell, two companies we like a lot, into making and designing these ASICs. So a company like Xilinx probably ends up losing a lot of share in the coming years, but still a net beneficiary of the growth in cloud and data growth out there. So if we kind of go to the next slide here, this just is a quick slide on GPUs and how they've performed relative to CPUs over the last several years, right? NVIDIA really being the leader on the GPU side of things. You can see a 5-year compounded annual growth rate, 75%. Intel, really, their data center business is all CPU driven. It's grown at about 13% clip over the last 5 years. These trends aren't going to reverse. Our view is GPUs probably grow at about a 15 to 20% clip long term. On the CPU side of things, you'll see low single-digit growth on their in their business. As we kind of go into the next slide here. So I just want to kind of now shift into away from those chipsets and just switch gears to the memory industry. And the amount of data growth really has resulted in a near need for a lot more memory, and that's been great for the likes of Samsung, Micron, and Western Digital that have had to deal with slowing memory content growth on the mobile device front. Right. In fact, last year the data center became a bigger end market for memory than the mobile space for the first time ever. About half of total demand in 2020, we expect, will come from data centers for the memory industry. So how does the memory landscape look today? Well, mixed would be the best way to define it. We're seeing, again, substantial cloud demand from the pandemic, which helped tighten memory prices through the first 3 quarters of this year. However, we do think that there's potential downside here in the fourth quarter and the first quarter after some of those order pull-ins. Now, we do like NAND flash more so than DRAM, which I'll show in the next slide in a sec. But at the end of the day, a lot of these mobile companies like Apple spending a lot less in terms of adding memory content. One, because there's already so much of it in these devices, but two, as we migrate towards 5G, those chips get very expensive. And as a result, they need to find a way to save money. They're saving money by not adding more money into these phones in terms of memory. And then I would say also in terms of the memory, what keeps us from being long-term bulls on the memory side of things, whereas a lot of other kind of sell-side firms out there are very bullish on the memory side of things, is China really ramping up quickly on their local memory manufacturing industry. And we think it's actually going to change the complexion of the market a lot here over the next 3 to 5 years. So we do think there are tactical opportunities to buy memory here and there. But as far as kind of a long-term secular opportunity in terms of memory, we kind of stay on the sidelines because of the uncertainty of what's going on in China today. So as we kind of go to the next slide here, So, in terms of, NAND versus DRAM, you kind of look at, I guess the best way to define NAND essentially is memory that stores data and holds it permanently, right? So think about taking photos with your phone, and then turning off your phone, turning it back on. That actual data is being stored with NAND. DRAM, on the other hand, loses the data when the power of a device shuts down. So, for example, in your cell phone, what you'll use DRAM for is maybe certain capabilities like video playback, where you're not actually saving or storing that data. So, on the data center side of things, both are really gaining a lot of traction. But with NAND flash prices coming down so fast, they're increasingly being used as a storage replacement for hard disk drives. And I'll get into that in the next slide. But our view is that NAND will see much better growth than DRAM. You're talking about 30% unit growth versus mid-teens for DRAM over time. And you can kind of see the boom period in 2018, and then in 2019, how far revenue fell off for both these sides of things. And you kind of see how a lot of that will come back on the NAND side of things, where things kind of level off more so on the DRAM side of things. So as we kind of go into the next slide here. So this just looks at solid state versus hard disk drive shipments, and really simply put, solid state devices, essentially NAND, which includes a controller to it. So 75%, 80% of the cost of a solid state is essentially flash, and that's really what you need to know. But you kind of look at the blue is hard disk drive units, which has really been on a sharp decline since 2010 when PCs peaked, while solid state, which is the gray bar, is in a really nice upward trajectory. And we kind of look at solid state revenue shipments. We expect to grow at a clip of 18% and 9% here over the next couple of years. Hard disk drives, no growth environment, we think benefits from that shift to the cloud, similar to solid state. So again, rising tide lifts all boats. But at the end of the day, as investors, I think it's important to note these trends. And I think really you want to be exposed more so towards the flash plays over time than, of course, the hard disk drive companies. So as we go, there we go. This is just really a quick slide here on the storage side of things. You can see that pie chart on the right side of things. Those are the market share leaders in terms of storage. Dell, with that acquisition of EMC a couple of years ago, makes up about a third or so of the market. But you kind of look at really I guess the one area I wanted to focus on was a company called Pure Storage. As far as all flash arrays, and I guess let me just define all flash arrays. All flash arrays are essentially data centers with all flash embedded in it. So essentially, companies utilizing less hard disk drives or not utilizing hard disk drives are now focusing on all flash because of the prices of flash have come down so much. So if you look at really where the share taker is in this space, it's a company called Pure Storage, which we like a lot. In the most recent first quarter, they grew 8% in a market that actually fell 8% year over year. So again, we actually like to oftentimes utilize Pure Storage or compare them similar to the way we compare AMD on the CPU side of things. So we think overall, great story. A lot of legs left for it. It's 1/3 of the market, all flash arrays currently. So there's a lot of traction for Pure Storage here over the next couple of years. Next slide here. So this is my last slide. Just looks at some of our recommendations on the data center side of things within the supply chain. The tap path is on the semi side of things, and I can list 30, 40 names here that are exposed or benefit somewhat from the data center, right? But at the end of the day, I put the ones that were most leveraged in terms of their revenue exposure. But you can kind of see the list. We're very constructive on many of these names, and it's worked out very well for us. Again, the share taker here, really, Advanced Micro, Broadcom is really the value play in the industry, and the name we would tell investors to play if you were a value investor, over Intel, that being kind of the other value play out there. Marvell, great story as well, a buy recommendation, not only a great data center play, but a great 5G infrastructure play as well if you're looking for that. Monolithic, also a great opportunity out there. And that's kind of a small niche play on the power management side of things. And then of course you've got NVIDIA on the GPU side of things. So when we kind of take a quicker look on the memory storage side of things at the bottom half of the slide here, we're a lot less constructive. The two names we are recommending, I highlighted Pure Storage, the other one being Dell, which we recently initiated on with a buy, and that's more of the ability for, we think, them to extract value from a potential spinoff of VMware next year. So I'll leave it at that, and at this point, I'll pass it over to Ken.
Thanks, Angelo. And we do have ample time, so please send us your questions via chat to the organizer, and we'll try to get to them. We did receive several. John, I'm going to kick it off with you. And given the size of the technology giants, how do you see Amazon and Google competing in cloud computing, and competing especially against Microsoft or Salesforce.com? What's the dynamics here?
Right. So thank you. So thank you for the question. It's if you look at what Amazon has done, if you go to there's the slide with the four different there's one type of traditional, right, software, and then the three software as a service, and then I think you can kind of look at platform as a service and infrastructure as a service as a similar continuum. So if you're a software as a service company these days, you're actually running your SaaS on Amazon. So you actually use their platform as a service or infrastructure as a service, say for AWS, or if it's Microsoft, for example, Azure, and you're running it on their platform. So it's kind of a three-layered approach. So the enterprise, right, subscribes to the software as a service provider, and the software as a service provider, right, subscribes to either Amazon or Microsoft. Even Salesforce.com has begun moving a lot of its workloads to Amazon, right? So it's those are two kind of very different markets. Having said that, I think Microsoft right now it's not an issue at all. But down the road, I mean, maybe it's I don't know. I thought about this. I'm not sure if it's an Achilles heel for Microsoft or if it's an advantage. I think it's an advantage for now. The fact that they have lots of SaaS products, right? I mean, Microsoft Office is probably the biggest SaaS product in the world, right? Office 365, and and yet Microsoft also, right, has an infrastructure service platform as a service. And normally you kind of want, church and state, right, to be separated, the infrastructure software side and the application side. You don't want the same bed. Enterprises tend not to like get locked in like that. I think Microsoft's an exception here. And so, I don't see that Amazon and Microsoft and Google Cloud really compete necessarily against the software as a service companies at this point in terms of cloud computing. They are, I think it's more of a cooperation at this point than a direct competition, between SaaS providers and, infrastructure and platform providers. But there's some interesting competitive dynamics certainly to watch and keep an eye on. But right now, I think there's so much growth, in the market overall that it kind of overwhelms any potential sort of friction down the road and competitive dynamics down the road between maybe software SaaS providers and the infrastructure side. So
great, Angela, I got two questions here. So, semiconductors and technology have had a great move. Let's say we're value investors, and Intel obviously had a disappointment with manufacturing delays now as it tries to get to smaller nanometers, perhaps even outsourcing. Are they going to outsource their manufacturing to Taiwan Semiconductor? Samsung is there. AMD, different, is doing better. So should we be buyers of Intel possibly as a kind of a value opportunity looking out over the next 1 to 2 years?
Yeah, so as far as Intel is concerned, the reason why we've kind of avoided them, and we actually had a buy recommendation until about January 2019, I believe we downgraded them to a hold. from a buy. And the reason we did was at the time we thought that AMD was primed to really start accelerating and taking some market share on their end of things. And the reason being is we started seeing them just kind of gain more of a presence within Alphabet and Amazon, among some of these other big cloud plays. And we kind of look at some of the manufacturing delays that have kind of evolved here. And this is the second straight generation where they've done it. It's proven to us that they probably don't have the right people to continue to kind of migrate towards a Moore's law philosophy, or even kind of or at the very least, what they're probably going to do is have to probably somewhat supplement some of their internal manufacturing and outsource of it. They probably outsource about 20% of their manufacturing today. We think after they've got they're going to have to go with 7 nanometers here, even with the year delay internally. Probably 2023 or so. Our view is they probably start relying more so on Taiwan Semiconductor, and they're going to have to. It's who AMD uses. They're going to have to utilize that as well. It's a big knock on them because they've historically been viewed as leading edge. That's no longer the case for them. So we would avoid Intel still as a value play at the moment until we see some stabilization on the margin side of things, on the market share side of things, among other issues that they're having. Again, what we've told investors, if you're looking for a value play, you've got a much better dividend in terms of Broadcom, much better content growth stories. They're an actual share taker in their respective end markets. So that's where we would be telling investors to migrate to if you're looking at the value play, the semiconductor industry, and see until we see some better prospects for Intel.
Okay, let's go in rapid fire on a bunch of questions. John, what technologies and software computing might the U.S. bring back from China? And is there any specific area you think that is critical either for our country's success or security?
Interesting. So yeah, I think one of the areas of software, I'll start with they're not probably going to bring back. I think the generic cloud computing and sort of traditional client server kind of software, even if that client server software has kind of moved to the cloud, for example, like CRM. I think generally speaking, I don't think there's a real issue with China, utilizing and paying for and all of that stuff. Where it gets a little tricky is the software that is used, for example, to design a chip. So software from the likes of Synopsys or from Cadence Systems, and even ANSYS. ANSYS has really complex simulation software, and one of the submarkets they have is design is simulating testing a chip, right? So you don't actually have to pay all that money to run a single chip off the line at Taiwan Semiconductor. You can virtualize that thing and run it as a simulation many times and fix all the bugs and so forth. That software, that's really critical. I'm not sure if it's how sure it's strategically critical for the United States, but certainly it's valuable for China if they want, if they're going to try to leap ahead, or even try to come close to where Intel and where Taiwan Semiconductor is, and where GlobalFoundries is, for example, in terms of their manufacturing, at 10 nanometers and at 7 nanometers and so forth. You're going to require a lot of really complex testing and simulation software from the likes of the companies I just mentioned. I think that's the one area that is still kind of a sticking point. Right now, though, I think if the trade right now it's somewhat restricted. So if it gets lifted, let's say after the election, then I think that's a positive catalyst for Synopsys, Cadence, and ANSYS. If that answers the question.
That's great. And Angela, last one's for you, sitting on your perch, not only on semiconductors, but on the theme of cloud computing and data centers. Talk to me about Apple or Qualcomm. Are they spectators or are they going to be participants?
Well, Qualcomm has tried to be a participant within the data center side of things, and they've got offerings to compete with the likes of AMD and Intel. But at the end of the day, it's the type of architecture that Intel and AMD reside on. That's called x86 architecture versus what's called ARM technology, and that's. At the end of the day, these cloud providers have a certain architecture in place, and it would be extremely expensive for them to use anything else. And as a result, it's very difficult for a company like Qualcomm to really penetrate much into the data center market. So as a result, we don't expect much from on their end of things. And as far as Apple is concerned, I think they're pretty complacent with kind of what they're doing these days within their respective markets.
All right, last one, John, Angelo. I like this question that came in. Are there any European or Asian up-and-coming cloud players? Great question.
That is a great
kind of like what we saw with internet with Tencent and others, Alibaba. So who could be on the horizon that either is a way for us to invest or one that could possibly hurt some of these new incumbents in the US?
That's a great question. Okay, so off the top of my head, the one that comes to mind, because I know they've invested in a number of startups around the world, and they have a big stake in Tencent. And Tencent hasn't really, they haven't done what Baidu and what Alibaba have done, and that is moved to the cloud, just like Amazon and Google and Microsoft. So I think that Tencent could move to the cloud, and I think that Naspers is a good way to play, which is a South African sort of media conglomerate that owns 30% of Tencent. But they also own a lot of like startups, and they have their hand in cloud computing kind of globally. And they don't really kind of touch the U.S. It's an interesting play on sort of say cloud computing and enterprise software with cloud in the developing world, or sort of outside of the U.S. and even outside of Western Europe. So that's the one I would throw out there.
Great.
And yeah, just really quick on my end, not much in terms of European based, but the one name I would throw out there is a name that we actually upgraded to a strong buy recently, NXP Semiconductors. Literally upgraded it about 2 or 3 weeks ago. They're a great European-based company. They've got some exposure to the data center, more of an automotive play, industrials and market play. But that being said, with the trade war going on and what have you, if things were to kind of intensify and get worse, a company like NXP Semiconductors, which isn't required to kind of abide by the U.S. laws here, has the potential to really capitalize and take some great share in the Chinese market. So that's a name I would actually be looking out for, and a name where we think the growth accelerates notably in 2021, and a great way to kind of play a potential vaccine play within the semiconductor industry.
Great. Kessie, if we can go to the last slide, which is upcoming webinars. And first, I want to thank John and Angela for just doing a fantastic job, and everybody on the call. Technology obviously is a big part of the bull market here. For CFRA, on our Road to Recovery webinar series, we have upcoming on August 26th, healthcare, COVID-19 therapies, and investing in the medical landscape. After Labor Day, it's hard to believe the summer will be over. We're going to see if both parties can do something across the aisle in Congress, but there's a bigger story here on American infrastructure, opportunities, risk, and politics. And then the end of September, the real estate road to recovery from the abyss. So we're really excited. We have our analysts putting together some very top of mind areas for investing. Obviously, we want you to visit MarketScope Advisor and certainly take advantage of all the breadth and depth that we have on the platform, as I mentioned at the beginning. Certainly want you to visit our also site for webinars. And if you have any questions, please send them our way. Please be safe and healthy out there, and we'll talk to you soon. Thank you.